In the 1920s, one man built the most feared criminal empire America had ever seen: bootlegging, gambling, extortion. Investigators estimated his organization was generating around $100 million a year. And yet, he wasn't brought down by murder or by violence. He was brought down by a tax form. Al Capone had a problem every criminal eventually faces. You can make millions illegally. You can even hide it. But the moment you try to spend it, buy a house, open a business, or walk into a bank, someone can ask one simple question: where did this money come from? Capone never found a good enough answer. And that failure exposed something criminal networks have been trying to solve for 100 years. How do you make dirty money look clean? That question has a name: money laundering. At its core, it's the process of disguising where money really came from, so it can be used as if it were earned honestly. It rarely involves duffel bags of cash. It moves through businesses, real estate, art, charities, offshore accounts, and now, digital assets. The goal is always the same: get the money into the financial system, break the trail back to the crime, bring it back out looking ordinary. It starts small. Cash sitting in a warehouse is dangerous. It's evidence. So it gets mixed into a business that already handles a lot of money: a laundromat, a nightclub, a car wash. Somewhere illegitimate revenue can hide inside legitimate revenue. But that only works at a certain scale. Once the amounts grow large enough, criminals need somewhere bigger to hide it. Property, art, rare collectibles, assets that don't have one fixed price. A painting can be worth $10,000 or $10 million, depending on who's buying and who's asking. That uncertainty is exactly what makes these assets useful for disguising where money came from. But eventually, ownership itself becomes the target. This is where corporate structures come in. A shell company isn't automatically illegal. Businesses use them for entirely legitimate reasons: tax planning, holding assets, structuring deals. But that same structure can be used to put a company's name on paper instead of the person who actually controls the money. Layer enough of these structures across enough countries, and investigators aren't chasing a person anymore. They're chasing a maze of paperwork. Banks sit at the center of all of it. They process an almost unimaginable number of transactions every single day, and they run systems built to catch suspicious activity. But those systems aren't perfect. Nobody has to be corrupt for money to slip through. Sometimes all it takes is one transaction that looks ordinary enough not to raise a flag. And then came the digital age. Cryptocurrency wasn't built for crime. It was built to move value quickly, across borders, without a bank in the middle. But that same speed and that same lack of a middleman is exactly what makes it attractive to people trying to move money quietly. Blockchain does leave a permanent record, but some services exist specifically to make that record harder to follow, adding a new front to an old battle. Because no matter the tool, the objective hasn't changed in 100 years: separate the money from the crime it came from. The crime happens in one country. The money moves through another. The company controlling it is registered somewhere else entirely. By the time anyone connects the dots, the trail is buried under years of transactions and paperwork. Money laundering didn't even become a federal crime in the United States until 1986. And still today, authorities believe hundreds of billions of dollars move through this cycle every single year. Here's the part that should unsettle you. When laundering works, the money doesn't look suspicious. It looks boring. A bank balance, a business account, a property deed, a paycheck. Because that was always the point. not to make dirty money disappear, but to make everyone forget it was ever dirty at all.